Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. Now, quite a bit of this conversation has to do with planning for the future, and sometimes that becomes hard to do. If you don't know exactly what you're saving towards, then how do you know how much to save? For example, if you're a young couple with a 3-year-old child, you don't know what that child is going to do eventually. They could be the next great painter, or they could be an astronaut, or they might want to study finance. Who knows? And so how do you determine how to go about your major goals? We're going to talk about this in a scenario building exercise today on Your Money Matters. My guest today is Abhishek, the co-founder and Chief Executive Officer of Epsilon Money. Thanks so much, Abhishek, for taking the time. Let's start by talking about this concept, right? Because a lot of people say you must save towards goals, but equally, there are other people that say if you don't know what your goals are going to be, you don't know what tomorrow is going to bring, shouldn't the objective be to save as much as you can while you can, and then worry about the individual goals down the road?
Sure. Thanks, Alex, for having me. Thank you for that. Look, there are different school of thoughts on this. You know, the traditional thinking has been save as much as you can, and you know, see how it goes. In India, we have a very strong savings mentality traditionally. For ages, we have saved 30 to 50% of our income. That's going down now with changing times. The consumption is taking over, but still we save quite a bit compared to, let's say, developed markets. Now, what happens if you don't plan as an investment advisor? We focus a lot on goal-based planning. And why is that? Because what happens if you don't plan and you leave things to chance, you may end up overspending on goals which come first, which invariably means that for a very important goal which comes last, which is your retirement, we are most unprepared, and that's what is happening with our society today. If you see, you know, the working class people like us, if we don't plan separately for retirement, the goal which comes last in our planning, and you end up, you know, let's say, overspending on your child's marriage, education, they are very emotional goals. You end up overspending, you know, as the kind of people we are. You don't have enough money for retirement, which means you end up working much longer than you want to, and assuming that you still have a job, else you'll have a very uncomfortable retirement.
So I just want to get into a scenario where, and I started the conversation with that. Let's assume that we're talking about a 35-year-old couple with a 3-year-old child, which I think is a pretty average household. And for the purposes of this conversation and the scenario that you've built out, you've talked about an income of 3 lakh rupees cumulatively. You're talking about monthly expenses of about 1.5 lakh rupees. So you're talking about a couple that is in a metro city. And of course, by the way, if these numbers sound a little high to you, then bear in mind that this is just an example, and you work out where you fit in the scale. You might actually be earning more than this, or you might be earning less. But you can work out over the course of this conversation what the calculation comes to. Sure. So we're talking about goals that they have in mind. So they've planned for 3 goals. They've talked about their child's education 15 years down the line. They've talked about retirement 25 years down the line, because they're 35 right now. Right. And they talked about buying a house, which they don't currently have. So that 1.5 lakhs actually includes a pretty substantial amount of rent, which could go away 10 years down the line. So how do we work out a scenario here?
Sure. So look at this couple, 35-year-old, have been working for about 10 years, double income, 1 kid, 3-year-old. A very major goal for them is to give their child the best chance of success, right? Which means they want to get the best education for their child. Being in a metro city, let's say they are able to send their child to a good school. They have thought of 1 crore for the higher education for the child.
Right now?
Right now, on today's price, for a 4-year education.
Sure.
Right? So that's one goal that they have. They need to allocate towards that. They want to buy a house. They want to avoid taking a loan, if possible, 10 years down the line. They're not in a hurry to buy. But 10 years down the line, they want to have their own house well before they retire. So the retirement doesn't have to be worried about the rent, right? And the third goal that they have, very important, I keep saying this is the most important goal anyone can have, is a comfortable retirement. Because that's what you work towards all your life, right? And as the families become micro, that whole system of, you know, a big household supporting an individual is kind of evaporating.
Yes.
So you need to plan your own retirement, right? Now,
and how much have we estimated that they need based on that 1.5 lakh expenses?
1.5, yeah. So they want to maintain their current lifestyle. They spend about 1.5 today. The rental cost will go down, medical cost will go up, etc., etc.
Yeah,
So
and they'll live in their own home, hopefully.
Exactly. So give or take, let's say they want to spend that 1.5, they'll travel more.
Yeah.
Right? So that 1.5 has to be maintained. Now 1.5 today is not 1.5 25 years down the line. So if you do a very simple 6% inflation, that 1.5 per month becomes 6.4 lakh per month. Right? So they need to plan accordingly. Before we get into any planning, the most important thing is working couple, life is full of uncertainty, right? You keep something aside
for your emergencies.
For your emergency need. So they've got about 1 crore saved up, plus whatever they got from their families, from the parents. So about 1 crore is there. The first thing you do is take out 6 months of your expenses, keep it in a safe place.
Sure.
A fixed deposit, a liquid fund, wherever you can keep it, right? So that's about 18 lakh. We allocate it first.
Yeah.
Then you start planning for your child's education. Now you spend 1.5, you also save 1.5. Now for the child's education, which is 15 years down the line, the child is 3-year-old now, will go to the higher education at 18. You do it in 2 stages because your risk profile changes over time. The longer the goal, the more risk you can take. As you get closer to the goal, your risk-taking ability reduces because you want to preserve what you have earned. And then your portfolio kind of changes, your expected return changes, right?
So you do a 10-year, first you do a 10-year SIP,
plan,
and then you switch it out. So, and how do you construct this 10-year SIP?
So what we do, we are assuming that they grow their income by about 8% per year.
Or 5% per year.
5%, let's say.
And so you increment the SIP as well, right?
Increment the SIP. Let's say you increment by 3%.
Which is a safe assumption to make. So even if you grow at 5%, you're going to be able to increment by 3%.
By about 3%, right? So every month, every year you increase your SIP amount by 3%.
Yeah.
Now what do you do? Out of the 1 crore saved up, you put 15 lakh as a lump sum investment for the child's goal, child's education. Then you start a SIP of about 42,000 per month, which every year goes up by 3%.
Sure.
This, and we run our mean variance optimization based model portfolio, moderately aggressive risk profile. We start with about 70-30 kind of portfolio.
70 towards equity, 30 towards
fixed income and commodities
and
right? We achieve it through funds, which we'll talk about later.
And we'll talk about that, yeah. So how much does that net you in 10 years?
So that in 10 years takes you to an amount of about 1.5-ish crore. And then you moderate the portfolio, your SIP continues now.
And you flip it.
And you flip it. So now your SIP becomes 56,400 because you started at 42, is growing at 3% every year. Now you're investing 56,000, which continues to go up every year for the next 5 years, right? And your lump sum amount, the SIP that you have saved so far becomes your lump sum today. So that remains invested. Now you change your portfolio to more conservative. Let's say about a 70-30 on the other side.
Sure.
More fixed income, less equities. And you continue to invest through that. That nets you about close to 3 crore, 2.95 crore all in.
Which is how much, which is more than you would need.
Which is more than you need. So even if you take 1 crore today, take a 6% inflation. Now, inflation is something, we have different opinion. But let's assume 6%. You need 2.4 crore at the end of 15 years.
So it's a sizable buffer, 60 lakhs.
Buffer, 50-60 lakh of buffer that you create by doing this. And you're assuming a 12% return at the beginning for 10 years. You're assuming a 10%. Given the rate of returns we have been generating in our economy, this is a
conservative estimate.
Conservative, reasonable estimate.
What about the house?
Then you come to the house, right? Now you used your 15 lakh out of your savings towards the child's education lump sum. You have kept aside 18 lakh so that your emergency needs are met just in case. Now you take out about, let's say, 48 lakh. You need the house in 10 years. You don't want to, the house cost you about, let's say, 1.5 crore today. Right? Now that house at 6% will cost you close to 3 crore, 2.7 crore, give or take, right? You take this 48 lakh, put it down, invest in a model portfolio that we will talk about. And this is a 10-year goal. It's a bullet payment. There is no, systematic or slow withdrawals you'll do, right? And then you do a SIP of about 44,000 per month. Again, you grow it by 3% per year because that's your ability to grow, right? This will take you to about 2.7 crore, very close to the goal, that you have in mind. So 1.5
And that's
crore
also
house,
at 12%.
That's also at 12%. Assuming a 12% growth, you get there. Now the third and the most important goal is your
retirement, right?
Out of the savings you had so far, you've got about 20 lakh left. You allocate it in a different portfolio, which is for your retirement.
Sure,
It's
and
a
that's
retirement
25 years.
portfolio. Yeah. Then you add an SIP of about 52,500 per month.
Okay,
right?
and so that takes your total amount to about 1.4 lakhs.
1.4 lakhs, right? You spend 1.5, keep 10,000 as a, you unforeseen expenses per month. That happens, right?
Yeah.
About 1.4 lakh you use for the SIP. So 52,500. Again, it grows at 3% per year. So the SIP amount grows. What you need at 1.5 lakh rupees expenses, 25 years down the line,
6.4 lakhs.
is about 6.4 lakh per month
Per
at the
month,
start
yeah.
of your retirement. It continues to grow.
Grow, yeah.
Now, if you do a full calculation, you assume that you live till 80, and you can argue we want to live till 100, let's say, but let's, for this calculation, assume we are living till 80. In those 20 years, with this kind of inflation, you will end up using about 15 crore. What you need is, for those 20 years, is about 15 crore, starting with 6.5 lakh and growing. Now, by doing this, you actually achieve about 15.7 crore.
Nice. So you're more than, and the allocation of this equity fixed income over 25
We start with
years?
about 75-25. When you get into retirement, you flip it to about 21-22% equity, because now your goal is income. Now, don't forget, you created a corpus. When I say you need 15 crore, it's not that you're using up everything. You've created a corpus, you're using money from that, but whatever is there is still growing. Let's say it's growing at 8%.
Sure.
Your inflation is still 6%.
Yeah.
You still make 2% net returns on the corpus you have created, minus any money that you take out at a much higher.
And we're making assumptions at this stage. One can assume that in 20 years the inflation rate might be different, and so you can readjust at that point.
You need to.
But having said that, let's get into the nitty-gritties of how you would allocate the SIPs that we've talked about, because at this stage you've said, at this moment, assuming that you have 1.4 lakhs that you need to invest starting next month.
Right.
How many SIPs do you need? How many schemes do you look at?
So look, asset allocation and diversification is a very interesting topic. We can, use up a whole hour for that, maybe in a different meeting. As I said, we use the strategic asset allocation model that we have, and we overlay with tactical. So let's start with the child's education. We start with an asset allocation of 71-29. 71 equities, mostly large cap to start with. Our ending allocation, when we become more conservative, is about 30% equity and balance into debt and cash. Now, to fulfill this, we get into mutual funds, right? And the funds that we choose are the funds, which give us this particular allocation through a look-through. Now, we are looking at one large cap fund, a flexi cap fund, which is mostly large cap, a mid cap, a small cap, a multi-asset fund, which also gives you the commodity exposure you need in your portfolio, along with the fixed income, and a bond fund. So I'm looking at 6 funds, not very concentrated, not very diversified. So you look at a Nippon India large cap, you look at funds which are, which have done well through different cycles. The fund management team has
Why
been stable.
not passive in the large cap space?
You can do a bit of, look, India is still a selectors market, while large cap is just about 100 companies. Depending on what cycle you are, the fund manager is able to create alpha. If you look at the, the history of our funds, we still manage to create alpha in large cap. So you can do
in the
50-50.
near term, over the last 16 months or so, you've managed to do that. But by and large, over the last 5, 7, 8 years,
good
post-cost,
alpha. Now the cost is again very interesting, because the larger the fund, the cost is lower.
Sure.
So that, the difference could be
and
as high as
you
100
picked a
basis
pretty
points.
large fund, yeah. Okay.
And we have selected, very, funds with very long track record, very large funds, done well, stable. We looked at their risk ratios, they kind of tick the boxes.
So that's one thing. You can choose to have either, an active fund, or you can have the top 100 or whatever. You can do that.
So in the large cap asset allocation, particularly, you can mix it with some passive.
Sure.
But that's a decision that is, you can take.
And then the flexi cap, you've taken something with a pretty long track record, mostly large cap. HDFC flexi cap is known to do that.
One of the biggest fund in the industry, is done very well, continues to do
A lot of people look at it in comparison with Parag Parikh Flexi Cap Fund.
Flexi Cap, which is another good fund.
Which is another good fund.
Yeah.
And then you've taken a mid cap and you've taken a small cap, and allocation towards both of those, more or less the same. So you've kind of split it.
We split it. We kind of try to get to a 65 to 70% large cap by doing all of this, and about 25 to 30% small cap, mid cap kind of portfolio.
Okay. So this is only for the child's education. What do you do for the housing?
Look, logically speaking, because all your goals are long-term goals, 10-year plus.
I was going to ask.
Allocation doesn't change too much.
Sure.
You don't need to change your fund just because there are different, goals.
Yeah.
You look at the time horizon. You look at a good set of funds. If you have a good set of funds, you stick with them. And the portfolio start is just the start of the process. You should do a half-yearly or a quarterly review with your advisor. Look at whether you are in the right funds. Look at if you are going in the right direction at the pace that you need to go.
Yeah.
And that will kind of, and if any rebalancing is required, we continue to do that.
Okay. So that's for the first two. So therefore, one is a 15-year goal, and you've suggested what to do after the 10 years, which is you make it less concentrated towards equity and you reduce the risk in your portfolio. And your housing goal, you could actually reach that goal faster. If, for example, equities go through a bull run over the course of the next 5 years, you might actually reach your goal faster, or 7 years.
Yes.
So, but having said that, the retirement goal, this is something that is 25 years away. So do you have a different approach there, or is it more or less the same?
So retirement goal, again, look, there's a very interesting concept called the glide path. Now again, subject that requires its own discussion, a very dedicated discussion. You cannot have successful portfolios, which meet your objectives without gliding it. So, there are target date funds in the US which are very popular. All the target date funds work on the concept of glide path.
We have target maturity funds here.
Target maturity funds.
The equivalent of that.
Equivalent of that. That should be on the glide path. When you create your own portfolio, that's what your advisor should do. They should create a pathway. So in the retirement, you have a 25-year goal, very, very long time away. You start with aggressive portfolio. Let's say, about a 75-25 or an 80-20 portfolio. Little higher allocation to mid small cap versus what you will do for 10 years. Let's say a 40% allocation. And then as you get towards the goal, towards that 25 years, last 5 years at least, if not last 7 years,
you start reducing the equity.
Bring it down to about 25%.
But the question that I have for you is that traditionally that mindset of flipping it and coming to if you start with a 75-80% towards equity, when you hit retirement, you switch it and you come to 80-20 fixed income more than equity. But would you say that is becoming how do you say it, more difficult to do because you need your capital to also grow to take care of a longer period of time? So here, as you've pointed out, you need to assume for 80. But if you think based on your physical metrics, based on your health, you expect that you will grow at the 85, 90, you would need to have more equity allocation, wouldn't you say?
So that tweaking needs to be done in your rebalancing and reviews. Right? You start with something where you plan for 80. As you go along, you may retire early, for example. You may live longer. So those assumptions have to be built in. You have to look at various portfolios. You have to calibrate. If there's some excess somewhere else, you can allocate more to this particular goal, but keep them separate portfolios, right? Now, asset allocation works beautifully. Even in your retirement, we're not saying you have a 100% fixed income portfolio because you're withdrawing, because for very fact that equities and fixed income work differently. They kind of hedge against each other.
Yes.
And that's why some allocation to equity, even in retirement.
I was going to ask, you've suggested a bond fund,
right.
And this particular fund, you've chosen the Bandhan bond fund. Is this a government securities fund or is it a corporate bond fund?
It's an income fund. Where
it's an income fund.
Fund manager, depending on the fixed income scenario, can take more allocation to a corporate bond or let's say a flexi fixed income fund. Now, what happens? Fixed income, unlike equity, needs to be, more shorter term approach by the fund manager because, there are interest rate cycles where you may want to be into, let's say, government bonds, and there are cycles when you want to be in corporate bonds. In a long-term portfolio, it's not logical to keep doing that because there's a tax impact. You keep changing your fund, you pay a lot of tax, right? So it's better to be on the bond funds, bond side, it's better to keep your allocation into flexi or dynamic bond funds or income funds, which basically the fund manager takes a call. Fixed income being a lot more complicated than equities, it's better to leave it with the fund manager.
Yeah. No, and that's a very good point. I like the fact that you've included a bond fund, because I think a lot of people sleep on the idea of having a fixed income, pure fixed income fund, and they don't realize, they compare it, they say, why should I look at this if I have fixed deposits? They don't realize that you can defer your tax payment down the line, and here you're talking about a pretty long-term portfolio.
So there's a huge difference between the way fixed deposit returns are calculated and fund returns. Fixed deposit returns are simple interest.
Yes.
They're not compound interest.
Right.
When you talk about a bond fund return, you're talking about, when you say 8% compounded annualized, it's a lot more than 8% fixed
100%.
investment. And that's where, when we talk about bond funds, we say if you're targeting, let's say 7 to 9% or 6 to 8%, compounded annualized, that's a lot more than a 6% or 8% simple interest. So that actually gives you a much better outcome.
Very good points that you're making. It's been an absolute pleasure speaking with you. Thank you so much for joining me. And the idea, of course, over the course of that conversation was to give you a sense of how to look at your own portfolios, how to look at your own goals, and who knows what is going to happen. It's quite likely that your child is going to do something that you did not imagine. And so from that perspective, if they become a famous painter, then all of the numbers that we've discussed go out of the window. You won't have to work another day in your lives. But you got a plan for it nonetheless.